Hi guys, it's Dale with the insurance. Today we're talking about an article that is a very good one. To be honest, there were nuggets in here that I completely forgot about, and it's very pertinent to our society because whether it's health insurance or car insurance or home insurance, we're severely underinsured. It's a massive problem, and obviously we try to help by making insurance kind of seamless and easier from a digital perspective, but we're still so underinsured. But this article gets to the heart of it. The title is "How the 80% Rule Impacts Your Home Insurance: A Complete Guide to Avoiding Costly Mistakes." Now, this 80% rule is something that is not talked about, but conceptually you'll get it. It makes total sense, right? And from a lender standpoint, it's basically, hey, you need to make sure that your home is at least 80% insured from a value standpoint, or else you can be penalized, right? And makes total sense because obviously the lender has an insurable interest in your home, and they know that you're almost incentivized, right, to insure the home for a lower price because it garners a lower premium, right? And we've all been in that situation where you're on the phone with a carrier or your agent and they're like, well, how much is your home worth? And because finding the value of a home is part science, part art, it's not really objective, right? So like, is it how much I paid for it, plus any bells and whistles I've added, any renovations I've added? Is it based on current market conditions? So it's a mix of all those things. And actually this article goes through step by step how you can get a good valuation for your home, which includes kind of like taking the square footage, taking the cost per square footage, adding in things that are current market based, right? Like labor costs, material costs, things like that change, and then you come up with a number. But once again, it's important because you can be left holding the bag if you're underinsured, right? First, if you're underinsured and you get a total loss, then you're not going to be able to rebuild the same. I mean, you may be able to rebuild something, but it's not going to be the same home that just got burned down or just was completely totaled, right? Because you're under 80% of the value, you're not going to get 100% of that cost to build it back, right? And on top of that, you'll be shorted even more because you'll have to absorb any penalty fees, which they spell out in this article. There's several ways a carrier may do this, but you'll have to absorb any penalty fees that your carrier may assess, right, for being underinsured, right? And I guess another good nugget that's kind of discussed in the article is replacement costs, and this is of lesser value because I think this is intuitive, and I think everybody kind of gets this. Replacement cost versus market value, right? Most home insurance policies are replacement costs for good reason, right? Your house burns down, you would like, and the financier, right, the mortgage company would like a company of the same like and quality to be rebuilt, right? And in order to do so, you need replacement costs, right? You need to replace this home with current like materials and at current labor prices, right? Whatever those may be, right? Market value, as you could imagine, is based on the market, right? What do markets do? They go up and down all the time, right? It's based on perceived value, right? Like what this house is selling at this time, right? So your home can be overvalued, which is great if you're looking to sell it, right? But if you take a loss and it's above the replacement cost and you've got market value, then it's not a good look, right? The other thing is really recognizing that difference, right? And it doesn't come into play that much. That's why we won't harp on it here. Just know that if you do take a look at market value, then you're taking a gamble, right? Because the value of the home will be connected to whatever the market is giving you at the time, and we know that's dependent on several factors, right? The other aspect and the difference between these two valuations is that market value does include land, right? Replacement cost does not, because once again, replacement cost is for damage to the property. Typically, having a fire or something like that isn't going to damage land, right? It's virtually impossible to damage land. So replacement cost does not include land, but market value does, which still isn't. I mean, it's still not worth having market value over replacement cost for your policy. Okay. Once again, very good article. I can't urge you enough to go and read it. There's a lot of information. I apologize for rambling and having such a long vlog today, but this article was very, very interesting and very, very good. It was a refresher. So thanks for stopping by, guys. We'll chat next week.
Hey guys, thanks for watching our video. If you enjoyed it, don't forget to hit the like button and subscribe to our channel for more awesome content. And if you really liked it, hit that notification bell so you never miss an update. We love hearing from you. We love hearing from our viewers. So be sure to leave a comment below with your thoughts on this video, and we'll see you in the next one.